Welcome into today's video. I'm going to be going over how margin of safety has saved me in my investing journey. And I'm going to be going over a specific case study here with PayPal. It's an investment I've bought into just under 2 years ago now, and I'm going to just give you a quick run through the thesis behind it and then sort of how it's played out since then. So let's start with the thesis. I bought PayPal 2 years ago. This is coming off COVID highs where the business had a re-acceleration of growth. Everyone had a bit of extra money to spend and was locked away at home. So naturally, PayPal benefited massively. Its growth rates jumped, obviously, and the company priced like a fast-growing tech company that was going to continue. And unfortunately, PayPal hadn't. It's a pretty mature business. Management had failed to really innovate previously. And what happened was the growth started to plummet, like a lot of businesses post-COVID. And that meant that you got these lows at about $55, $60, where the investors just hated PayPal. They'd been burnt on it. This company traded at $200 and now people were giving it away at $60. And because the growth had slowed, they'd realized, oh, actually, it wasn't sustainable. And they'd been burnt by and just fed up by the fact that this company had been hitting new low after new low for 2-3 years straight. So that's where I come in about mid 2023. And what I'm effectively looking at is a business here which is trading about 14 times earnings, 12 times forward earnings for a blue chip company that's been around the block, been around for ages. And though it is in a competitive space, it is still meant to eke out some growth. And it has a very healthy balance sheet and new management that has come in place who is supposed to not revolutionize the business, but pump growth back into the business by using his expertise so Alex Chris, the new CEO, using his expertise at QuickBooks, where he grew QuickBooks, an online accounting software platform, which is a very competitive space. He grew that at 20-30% a year for at least a solid 10 years. So to me, that at the time gave me a lot of confidence that actually he's going to be able to transfer that skill set that he has there, specializing in growing this business by focusing on the customer, improving the product features, and add that into PayPal, and that's going to refuel their growth. They're going to pick up new customers. And even if the business can just grow high single digits or go from growing 4% a year to growing 7, 10, 11% a year, this business is going to do really well as it re-rates. So that was the thesis behind it. And then finally, PayPal has this huge untapped potential of millions and millions and millions of customers and very high quality targeted data, which it isn't yet monetizing as part of its advertising business. Just to give you an example, I was looking at the likes of Uber, who at the time had done very well off this thesis, off this type of model, where they've got significantly lower quality data. Because, I mean, think about it, Uber, you can only see the rides and where people go to. So are they going to a restaurant or are they going to a supermarket? And you can only find out what type of food they're ordering. You've not really got a whole lot more data than that at the minute. Now, obviously, that's still valuable, but when you can contrast that to PayPal, who knows what hobbies you have, where you're spending most of your money, and that quality of that data is significant because it allows you to then advertise at a much deeper level, have much more targeted adverts, so merchants can give better deals to customers, so they do benefit there. But equally, these merchants are able to upsell much more significantly through this platform, and then PayPal generates very high advertising margins on that sort of revenue coming in. That was a thesis there. I mean, Uber grew it to 1 billion based on the number of users PayPal has and the quality of its data and how well it's monetized. I was of the belief that actually this could PayPal could have a larger segment than Uber did here on their advertising segment. And last time I checked, Uber's segment had just crossed $1 billion. And if you think, well, it's an advertising business, it could be at 50% margins, that's easily 500 million. I think that PayPal segment could be much bigger. It could be a billion, dare I say 2 billion net income in the future. And that will significantly add to its growth. As a result, the business is more profitable, higher price earnings multiple associated with it. That was the thesis in a nutshell. So we have this great CEO who's got a proven track record, who's going to come in, boost the growth, improve innovation, and then also they're going to take advantage of that white space that PayPal has not been using for ages, which is their advertising business, that they're going to finally get off the ground. So that was the core of the thesis. So 2 years later, what has actually happened? Well, to be honest with yourself, first year was pitched to investors as a transition year. It's going to take the management a year to put in a new management in place, which is fair enough. I mean, they did bring in new executives and sort of build up that experience. They did bring in the likes of the CMO of Uber, actually, who led that advertising business and then was supposed to transition it to PayPal. And then they brought in their executives, and this was going to be a slow growing year, so that the next year PayPal is really going to shine. And I could be a bit early in saying this because, it's only been 2 years. I might be completely off here, but at this very moment in time, it seems to me that PayPal has actually not grown that much since then. In fact, its growth they've had to lower their estimates, and their growth has growth rate has continually declined over time. And even though this was pitched as sort of the year of growth, that management has now finally got its board together, they finally developed this product, they've had these conversations with their customers, and they're starting to take pricing. And yet we've not really seen much growth. We've seen a slowdown in growth. I mean, at this point, they're barely eking out any growth. And yet you might think, well, that sounds completely horrible. And then if you top it off with the fact that actually their advertising business hasn't really done a whole lot of anything at this moment. Whereas you've got Uber, and the expert from Uber, who's supposedly meant to grow this segment significantly. And even when you think that, wow, David, your projections here were way off. Everything that you thought was going to occur was completely off. So how is it that I've still made money, even though I was completely off, and basically everything I said was the worst case scenario almost has played out? Well, there's a few things here, and the main thing behind this is actually because of my margin of safety, and I think that's why a lot of investors emphasize this. So even though the business has underperformed, in my opinion. Again, it's still early. It could completely change 2 years from now. I don't think that I would have done nearly as well in this, frankly, poor performance of the business compared to what it could have achieved or was thought it would achieve. I don't think I could have done as well had I not bought at a large margin of safety. And what do I mean by that? So what I mean is that whilst almost every single company in the stock market in the US was trading at 20 times earnings of PayPal's size, if not, dare I say, more, PayPal itself was trading about 14 times earnings, so significant discount. It had some growth that it could eke out, plus it had a very healthy balance sheet. So if you did if you excluded cash from the market cap, so an enterprise value, you'd get an even cheaper valuation because the balance sheet is in a very healthy position. They've got not much debt relative to how much cash and how much current assets they have. And yet, on the other side, you have companies which, again, are growing just as slow, which are trading at 20 plus times earnings. So to me, I think that's what's really helped me out here. And actually, over the 2 years I've held, PayPal has gone from $55 to $75 over here, which isn't a whole lot, but that's still 40% return over 2 years. That's like an 18% annualized return. I mean, that's not anything to really scoff at. That's not bad. So yeah, really happy with the outcome there, even though I wasn't necessarily happy with how the business and how the management has performed. And I think that's in large part come down to margin of safety protecting the business, and also because they had a strong balance sheet and because it was at a cheap valuation. One thing management did do, and they did do well, was they were able to buy back shares at a very dirt cheap price to earnings, which has then made the business even cheaper. So I hope you found use in that case study. Again, it could be a bit early. We've not seen out how all the innovations have played out long term. It's only been 2 years into this story. But thanks for listening, and I hope that case study was quite useful. Thank you.